The 20 year is the highest it's ever been, and the 30 year is well, at its most recent high. And yeah, I think also 2000 highest level since 2007 also, so preceding the 2008 financial crisis. Bond volatility has moved up once again. This is putting pressure on the dispersion and correlation trade, which I noted last night in my kind of like infographic Twitter post. If you guys haven't seen that, you can check it out. I think the link to my Twitter is below. But basically, as bond volatility climbs, that makes index volatility also climb, which is kind of what we were talking about there with the forward return of VIX. And so that pressure pushes volatility out of equities and into the indexes, where, and higher volatility environments tend to mean that indexes go down, and lower volatility environments tend to mean that equities go down. And so as that dispersion trade collapses, more and more participants are encouraged to go short equity and long volatility, right? And bond volatility is a significant driver of the opening and collapse of those trades. And bond volatility rocketed down very, very hard from the March peak on the back of the Fed backstop and the promise of security in the banking system. And we saw about 6 months of pretty steady decline that was offset with a few dips and scares in SPX. And those have, since the September Fed meeting, bond volatility has done nothing but climb. I think it's probably up like 37% today now. And it just keeps climbing. And the more that climbs, the more that's going to break down the dispersion trade between indexes and the underlying assets in those indexes. And that's something that we saw happen towards the end of 2021. This trade, began to break down when JPOW announced that they were going to taper their bond buying. And then again more when they announced the rate increases in March of 2022. So taper in November of 21, rate increases in March of 22, and then progressively throughout the year, as rates were increased, bond volatility would pick up and dispersion would break down even more. And that continued really all the way into the low in October of 2022. From that point on, bond volatility kind of cooled. We went up through Jan and Feb, and then in March, obviously, bond volatility picked up a lot because of the bank failures. And then as that cooled, dispersion picked up once again. And that persisted for about the last 6 months. Now that bond volatility is on the rise, and it doesn't appear to be stopping due to the reflexive nature of the position that bond portfolios are in now, we will probably continue to see that dispersion trade break down over the coming months. Now, that doesn't mean that we can't have bounces, we can't have rallies. But we are shifting into a higher market volatility regime. And we're going to see, probably reduced margin projections for equities. And I think that could last for some time, as long as the Fed is going to continue to maintain its higher for longer policy. And that could be easily into the middle of 2024, and with geopolitical conflict and stuff right now, maybe even further. So buckle up.